And that's the real distinction here that I think so many people are missing. Nasdaq and the NYSE may really start looking more alike on paper, but they still operate very different in practice. Have you ever wondered what's really happening inside the microcap markets, or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Microcap Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman. Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most committed and ambitious entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or just operating inside the emerging growth ecosystem, this briefing is for founders, public company leaders, and other capital markets professionals who want to understand how this market actually works today. My goal is simple: to give you a clear, real-time view of what's happening in the microcap markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings, to reverse mergers, SPACs, and secondary offerings across all aspects of the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference.
I'm Caroline, and welcome to Inside the Microcap Markets with Joseph Lucosky. On this show, we take some of the most current and pressing questions on the minds of those of you in the microcap ecosystem and break them down in a live question and answer format for Joe to give you his take from the trenches. Before we get into today's questions, Joe, just tell us from a high level a little bit more about what you're seeing there on the front lines of the emerging growth ecosystem.
Well, Caroline, I continue to say right now it's a very challenging yet interesting time in the micro cap and emerging growth ecosystem, because we're seeing a real period of redirection in the industry, especially around all things Nasdaq and New York Stock Exchange. I mean, the market has completely changed. The rules have gotten a lot tougher, and too many people are still making listing and financing decisions, in my opinion, based on assumptions that are no longer true. So it's definitely an interesting and I think exciting time right now. And as with any challenging time, there continues to be, I think, a real opportunity for those who understand what is really going on in the marketplace and, more importantly, where this market is headed.
All right, well, I'm glad that you brought up NASDAQ and the New York Stock Exchange, Joe, because that is exactly what I want to get your take on today. This episode is really all about the U.S. senior exchanges and the real differences between them in 2026.
Okay, that's great, Caroline, because I love this topic, as you know, and I think about it all the time. It's really one of those topics that I think a lot of people in the marketplace believe they understand until they actually have to make a real decision about it, or unfortunately, sometimes when it's too late in the process.
Right, and that's exactly why we wanted to do this episode based on the questions we've received and really what's currently going on in the marketplace. But before we do, let's just level set here. Especially for those of you who may be new to the show, these are real questions that we have received from companies, board members, investment bankers, and even live deals. So if you've got a question, please send them to us at questions@lucbro.com. That's questions@lucbro.com, and maybe we will cover it on a future episode. So let's start here, Joe. For years, people assumed that NASDAQ was the more natural exchange for microcap and emerging growth companies, and we saw this in a lot of the questions we received on this topic, while the NYSE was more selective and harder to access. Is that still true today?
Well, Caroline, the answer is really yes and no. And what I mean by that is historically, NASDAQ absolutely had the reputation of being a little bit of an easier fit for microcap companies because the process generally felt more formulaic. You know, you made an application, you paid your $5,000 fee, you got assigned a listing analyst, and then you really worked through the process with the company and the exchange. So even if things got difficult later, there was still a feeling that you could get through the door, engage, and work your way to a listing. But as of December 2025, that has all changed now.
And the NYSE was never really viewed that way, or was it?
No, I mean, not really. The New York Stock Exchange always had a more front end vetting mentality. Before you really got to the formal application stage, they really wanted to understand the company and its business and a little bit about the management and even sometimes the industry and even the numbers at times. And candidly, the real question that they wanted to understand still to this day is whether they really wanted you at all. And if they didn't like the company or they didn't like your risk profile, and they will tell you this themselves, if they didn't, really even like the color of your tie, they'd be more likely to tell you very early, hey, we're not interested. And that is something the New York Stock Exchange has really never been shy about.
So what you're saying is that for a long time, Nasdaq really felt more procedural and the NYSE felt more judgment driven. Is that the takeaway?
I mean, yeah, for the most part, but that was really the old perception. And I'll tell you, Caroline, it didn't come from nowhere. It came from years of the exchanges really operating in that fashion in practice. And we've seen this over many years from the trenches. But what has really changed now is that NASDAQ has spent the last year, all of 2025, really tightening its rules so aggressively that the old idea that NASDAQ being the obvious or default choice for emerging growth companies is really not nearly as safe anymore.
So when you say that Nasdaq tightened aggressively, tell us what you mean by that.
Yes, well, I mean that in 2025, it was a real turning point for the industry. Early in the year, meaning 2025, NASDAQ said companies had to raise $15 million dollars unless they had net income. They really reestablished the floor for a microcap IPO. Then later in that year, they took the net income exception away, basically because a lot of these Asian companies that were good companies were able to meet that net income exception. And that caused a little bit of volatility in the industry. So they said, now look, doesn't matter where you are from or how you operate, you all have to raise $15 million. And then they pushed that even further in late fall of 2025 and said, well, now, if you're a Chinese company, not Asian, but Chinese, the minimum we're going to move to $25 million. So the whole industry got uplifted to a $15 million capital raise, and Chinese companies now have to raise a minimum of at least 25 million.
And then December was the really big one, right?
Yeah, it was really big. In fact, in December, and I think a lot of people have now sort of come to be familiar with this, NASDAQ adopted rule IM 5101-3, and that's NASDAQ's new discretionary rule. I mean, that is a huge development in the industry. And really, Caroline, it came out of nowhere, meaning it was announced and implemented on the same day. And that rarely ever happens. I mean, I remember I was sitting at my desk and someone had emailed me and I said, whoa, what is this? I mean, wow, a new rule. And I was looking for the implementation date and it was literally that day. And all these posts started going off on LinkedIn. So it was a really, really rare occurrence. And that rule really made crystal clear now, among a lot of things, that NASDAQ can deny your listing on the exchange really for no reason or any reason at all, even if you meet the qualitative and quantitative standards. So that really changed the entire conversation in December of last year. While NASDAQ right now may look a little bit more procedural in how you enter the system, it's no longer a check the box exercise once you're there. And I think that is what a lot of the market still hasn't fully appreciated.
So what you're saying is that the front end of the process may still be the same, but the real review standard to get to Nasdaq is very different now.
Yeah, that's right. I mean, the application may start the same way at the beginning, but the analysis at the end is totally different and much harder.
Okay, so if Nasdaq was raising the bar that aggressively, what was happening on the NYSE side? And does that mean that the two exchanges are starting to look more alike?
Yes, on paper, that is the case. And I think this is what you're really trying to tease out of this episode because for a period of time, the NYSE was sitting at $10 million minimum capital raise. And then NASDAQ really sought to move the bar higher. And remember, the NYSE was actually the first exchange to establish a minimum, and it rocked the entire industry back in September 2024 before NASDAQ upped the ante and moved the minimum capital raise to 15 million in really January through April of 2025. So for a moment in time, it actually looked like Nasdaq had taken the pole position in setting the bar higher for microcap companies. Then remember, later that year in 2025, NYSE followed, and at least informally and now formally, they moved their minimum from 10 million to 15 million. So when you step back and look at the exchanges in the market, the standards are definitely converging.
Okay, so is that why I keep hearing you say that the gap is closing?
Yeah, in some sense, but it's a bit misleading. And if you're not in the trenches, you really wouldn't know this because most of the market is still missing, I think, the real takeaway. And that is that the gap is closing on standards, but not necessarily the process of how you list. And that's the real distinction here that I think so many people are missing. NASDAQ and the NYSE may really start looking more alike on paper, but they still operate very different in practice.
Is that really the heart of it then? That the standards are getting closer, but the actual path to getting listed is still very different?
Yes, the main thesis when you talk about the senior exchanges is that the listing standards are converging, but the process is not. In my opinion, NASDAQ is still fundamentally an application first process. You apply, you pay, you get assigned a listings analyst, and then you work through the comments and the issues and the questions from inside the system. The New York Stock Exchange is still much more of a judgment first process. They really want to get comfortable with you and your company before they really let you in to the system. And the flip side of that is this: if they don't like you or they don't like it, you're going to find out earlier in the process. And by the way, they will tell you that themselves. So while both exchanges are, they're tightening and they're moving closer together on paper, they're just tightening in different ways of the process. I mean, let me boil it down like this. I think NASDAQ says, in effect, come into the process and we'll work through it over time. The NYSE says, more or less, let us decide first if we even want you in the process. And that's a major practical difference that I think people have to understand.
So that doesn't really sound just like semantics. I mean, that must have real consequences for how companies and bankers should think about which exchange to choose, doesn't it?
Yes, it has major consequences. And I think a lot of people overlook them because if the process is different, then the strategy, how to list, has to be different too. That means the exchange choice is no longer just about, you know, perceived prestige or what logo looks better in the press release. It really has to be about fit, but more importantly, I think about probability of success and how the company will likely be viewed in the actual process. And it's really not hard to figure out if you know where to look.
Yeah, that's a great point, Joe. I mean, if someone is really choosing between one exchange and another in a live situation, can you just give us a real life scenario where you would say that one exchange may be a better fit than the other one?
Yeah, absolutely. Here's an example that just came up recently. I mean, we had a company that was going to raise about 20 to $25 million, somewhere around there. And they knew that the book in the IPO, and this deal is still going on, was going to be a little bit more concentrated, meaning they had two sizable orders. And the reason they were able to predict this was because they had one large institutional investor that had been following the company for a very long time. And they also had a large customer that was doing business with them that wanted to invest in the IPO. So in that kind of situation, we could really never send that deal to NASDAQ because in today's market, that book would likely not get qualified by NASDAQ because of their concentration and distribution analysis that they do on every IPO. I mean, at least from what we have seen and from what we constantly hear across the market, NASDAQ has become very skeptical of large anchor style orders. Now, I'm not saying they don't like anchor investors. I'm not saying anchor investors aren't welcome. What I am saying is that concentration and distribution analysis is very difficult. So even when you have a high quality investor, a large customer, somebody that, you would think is a great win for the company, and that's going to concentrate the book a little bit more than usual, that's going to be a tough choice for NASDAQ. Whereas the New York Stock Exchange is a little bit more accepting of that type of order from an anchor investor. So, Nasdaq wants a very, very distributed IPO book. And if your deal is going to have large positions, that becomes a real issue. And in that same fact pattern, the New York Stock Exchange likely is a better fit because they're generally going to not scrutinize that book in the same way Nasdaq would. And that deal would likely get over the finish line in a little bit, easier fashion.
So let's get really practical here. I mean, if you're a founder sitting here right now trying to figure out where a company belongs, what should actually drive the decision between the NYSE and NASDAQ in this market?
Well, first of all, let me just say this. I think people have to stop relying on the old playbook. So many advisors and consultants and even attorneys are running around out there, in my opinion, without a real clue how the industry has changed. Look, anyone can parrot the buzzwords, but that doesn't really help you get through the system. Now, I'm not attacking anyone. There's a lot of good lawyers and advisors out there, but I'm telling you, I am hearing consistently from people who really don't have a clue how this whole industry and dynamic has changed. If the whole analysis from these advisors is just NASDAQ is where companies like you usually go, that's not a strategy. That's a really bad habit, in my opinion.
So wait, if not habit, then what? Tell us more about that.
Well, the real question now is not which exchange sounds better, or which exchange you prefer because you may like them more. The real question is which exchange is the right fit for your company at this time. Most importantly, what is the probability of you successfully achieving a listing on that exchange? That means looking at everything from your business to your management team, your industry, your jurisdiction. The list goes on and on and on. And your ability to raise real capital and how that capital will be raised. The complete full picture, because right now it's no longer about just do you qualify? More and more now, Caroline, the real question is, does the exchange believe you belong there? And whether the company can actually succeed after it gets there. And it's also important, in my view, who is representing you and presenting you to the exchange. What worked in the past for some consultants and other advisors will no longer work today because the process is no longer mechanical. It's an advocacy-based system that needs a real leader, not a process-based, check-the-box, document-driven process.
And that's definitely a different mindset than just how do we get across the line?
True, but don't confuse getting listed with being ready. I think this is another thing that the industry just, confuses a bit. A lot of people still think in terms of how do we just get across the finish line? And that's really the wrong mindset. We should really be asking what gives us the highest probability of success or approval and the cleanest process. I just did a panel with some of the people from the New York Stock Exchange and NASDAQ. We really talked about this type of these types of issues, meaning deals that are just squeaking by or metrics that are just being met just to get approval instead of, what is the underlying foundation of the company and why do they belong on either the NASDAQ or the New York Stock Exchange. That is a new paradigm in our industry and one that I think has to be taken very, very seriously.
So let's go back to something that you just said a minute ago. Can you just tell us about how much does the advisor team matter in that analysis?
In my opinion, it's the most important decision in the process. You need advisors, anybody, whether you're doing an uplist, a direct list, a cross list, an IPO, you need advisors who understand how the exchanges are actually functioning today, not how they functioned years ago or even 10 years ago or, someone they knew at the exchange a long time ago. That doesn't work anymore. The strategy in this market or that strategy is very dangerous because the market has changed so much and the standards have changed. So that really means that the exchanges are taking a much harder look at these companies and using their discretion on every single deal. And too many people are still walking around like it's no big deal or it's 2025 or even 2021. It's not.
Okay, bottom line, Joe, what is the one takeaway that you want founders and deal teams to remember from this episode?
I would say the one takeaway is really this. For years, Nasdaq was seen as the more formulaic exchange, and the New York Stock Exchange was seen as really the more selective one. And that perception, grew over time. But today, those standards are really getting closer together. And the bar is getting much, much higher for both exchanges. And that old assumption that NASDAQ is automatically the easier or obvious choice is just not reliable anymore. So, yes, the gap is closing a bit, but the real difference now is not only the rules on paper, it's how the exchanges practically evaluate companies, how they run their process, and whether or not they think your company is a good fit. So if you're making an exchange decision in 2026 with an outdated mental model or an outdated consultant, you're really, really behind the eight ball.
You've been listening to Inside the Microcap Markets with Joseph Lucosky. For more insights from the trenches of the microcap markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@luckbro.com. That's questions at LUCBRO.com. Thank you for listening, and we look forward to next time.